Morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg. And it's the FOMC day today. Now, after the release of decelerating inflation data yesterday for the US economy, it may turn out to be easier for the Fed to pause the hike cycle for this session at least. Inflation looks to be moderating across economies, with India also posting a lower number the day before. So, JK, what do you think? Are we at an inflection point for the monetary policy cycles with the inflation moderating? And what should we be expecting from the FOMC tonight?
Good morning, Shikhar. Definitely, I'm not reading too much into this inflation number because it has had a huge base effect advantage, and would really like to see numbers coming after June, rather after July. So. Even if you look at the core number, it is accepting the year-on-year, which came in as expected, lower than last month, of course, but came as expected, and then the month-on-month holding on still at 0.4%, and annualized based on this is still above 5%. So not too much comforting. Yes, then we have a lot of time before between June and the July meeting, so we will see what happens to the economy and the inflation. In fact, there have been a lot of news flow in focus for the last 24 hours. China cut its reverse repo rate ahead of the soft credit growth data, stronger than expected labor market data from UK, and then what should have been a headliner US CPI coming broadly as expected. And then yields have been higher, and the USD lost 0.2% on the DXY. Now, in US CPI itself, of course, 0.1 percent month on month on the headline end of 4.1, rather for 4% on year on year, as per 4.1 expected. Now, as I said, the base effects had a huge impact on the numbers. But despite this, how often do you see US yields rallying after a soft CPI data and ahead of a certain pause in the rate hike cycle by the Fed? One would have expected yields to drop. But what we saw yesterday was a 2-year rising by 10 basis points, 10-year by 7 basis points, and 30-year by 4 basis points. Now, it had nothing to do with the CPI data actually, but everything to do with the UK employment rate, rather the UK employment data, which came very strong. Now, UK gilts rose an eye-popping 25 basis points in a single day, and that's a 25-year high that was last seen in 2008. And after the data, dragging yields higher across the nations. The other factor has been the huge supply of fresh papers by the US Treasury, with investors clearly demanding higher yield. For instance, the new 30-year bond auction for 18 billion yesterday had a cutoff at 3.908% versus 3.741% in the previous auction. Now, more on the UK data, it was strong on all counts. Unemployment rate fell to 3.8% versus 4% expected. Average earnings, excluding bonuses, rose to 7.2% year on year, up from 6.7%, and 6.9% was expected. And also, the large fall in the employee payroll last month, which had initially signaled some easing in the labor market, actually got reversed entirely. Now it came at much higher, 136,000, and the preliminary May numbers also show a further increase. So the market pricing has surged to imply a bank rate of 5.75% by December. That is 1.25% from the current rate of 4.5%, and 13% chance of a 50 basis points hike as against 0.25 steps that they have been following in the recent months. So it's not surprising that a 2-year yield soared to 25 basis points. Pound pushed above 1.26 and sustained the gains. Now, just for a perspective, UK pound was worth $2. One UK pound was worth $2 in 2008 when the yields were this high. Of course, not concluding anything because a lot of relative economic conditions have changed. Now, on the dollar itself, the greenback is showing a mixed trend within the DM currency. It has been notably weak against the GBP, as I said already, with UK data, and ranging against the euro, as both the US and European economies are showing weakness, while being quite strong against the yen and the Chinese yuan based on the yield advantage. At the same time, it has been weak against high-yielding EMs, where inflows have been observed in line with the recent improved stock market sentiment. So the mixed trend in the dollar, I feel, is likely to continue until we have a clearer picture on the inflation trend post-June. consumption pattern or retail sales of this week should give some evidence. The dollar index likely to hover between 103 and 104, and euro between 107 and 108, while GBP's outperformance should continue for new cycle highs. On the USD INR, yes, it has followed the EM pack generally, but not with the same momentum. Again, central bank, having its influence, and yes, definitely we have been drifting lower slowly. From the high of 80 to 68 in this month, where we were at 80 to 20 yesterday in offshore trade. Now it is at 62. 80 to 28. Yes, flows have been still ongoing. Apart from FII flows, we also had corporate flows, which is which has been helping the rupee. And any momentum of appreciation obviously depends upon the the central bank, but which is again looking at what is happening in the Chinese one. Chinese one, after showing signs of recovery yesterday, is again back at 7.17 plus. So don't expect too much of appreciation in the INR. Thanks to the central bank's intervention. Now we have a lot more coming up for the rest of the week. Apart from the major ones being the Eurozone industrial production, ECB rate decision, US PPI, US retail sales, and all eyes on China macro data on industrial production and retail sales on Friday. Of course, India's trade number, which has been making headlines with a big fall in the deficit, will also be out tomorrow. So we have a lot to look forward to. And of course, we start off with FOMC tonight. No one really has a doubt that they will skip the rate pause today. But what I'll be looking forward to will be their forecast, what Powell says about the months ahead, and the dot plot itself might be very interesting. So very interesting evening ahead. Perhaps till then we will be in a very rangy market. Thank you.
Okay, JK, thank you so much. And not just an evening, I think the way you have been saying, I think it's the whole week, which is going to be quite interesting with the numerous data updates and the central bank meetings lined up. We've already had the US inflation, Indian inflation numbers. Now we await the CNH or the Chinese macro numbers, Indian trade balance numbers, and some US PPI and industrial numbers. So it's going to be a data-packed week, and there's going to be some action with respect to these particular data. But what we have also observed is these strong macro numbers from the UK. I mean, the good employment numbers and the average earnings staying strong. It shows some sort of strength for the UK economy, at least for these particular numbers and the current session. And what was interesting to watch was the UK gilts trading higher. Now, these are some sort of reactions, but I really like your point wherein inflation numbers should be still weighted and observed for the months of June and July, because these numbers do have their base effect. So we'll wait for June and July numbers to get some sense on whether the inflation is actually moderating for the time being or not. That's it for today, folks. We shall come back again tomorrow morning with the fresh update from the FOMC, and as JK mentioned, the forecast by the Fed team, which we are keenly waiting for. Thank you so much for listening.